these thousands of currently small businesses that would become big drivers of GDP in the United States over the next 10 years, they're never going to get a chance to actually be that in the future. And that will be to the detriment of thousands of jobs, if not tens of thousands of jobs in the future.
Gary,
these depositors will not survive, weeks or months without some sort of plan from the government.
Around 1 year ago, the Federal Reserve started aggressively raising rates to combat inflation. Last week, we may have entered our Lehman moment for the COVID stock market bubble, which was largely driven by speculative tech. Enter SVB Financial Group, the preferred banker of Silicon Valley venture capitalists and private equity, who went from thriving to receivership in just 2 days. We made some charts about it, looked at their filings, and I'm going to walk you through what happened in this video. The market first caught fear of SVB when they filed a prospectus for a lousy $1.75 billion equity offering, which was meant to come in ahead of a $500 million order from private equity firm General Atlantic. The prospectus seemed pretty unremarkable at first glance. But when we dive a little deeper, we realized General Atlantic's commitment was contingent on full subscription of the rest of the offering. For us nerds who read news releases, this may have been the first showing of a crack in the dam. It's a bank, not all that exciting, and as of last week had a $211 billion balance sheet, a $28 billion enterprise value, and capital ratios all within the tolerances required by the Federal Reserve and state regulators. It's used to going to the market every once in a while to raise a few bucks, but those raises never make the news, let alone cause the banking index to implode. Not a large single fire, just lots of smaller fires, cash fires, if you will. To be able to take deposits, the rules say the bank has to keep a certain amount of liquid reserves. Generally, those reserves are kept in approved government paper that doesn't fluctuate much in price and can be sold if it needs to be. Pre-collapse, SVB held various kinds of safe, boring stuff that paid a return so reliable and steady it might put you to sleep. Fine, high-grade banking reserve paper. For accounting purposes, that paper comes in two categories: available for sale and held to maturity. They're all the same types of bonds. The bank just keeps the ones that it will sell if it needs to in another category, which is important, and we're going to get there shortly. But let's go back to that $1.75 billion raise. The amount of money in the raise isn't as important as the reason they needed it. The prospectus went on to disclose that SVB had sold substantially all of its available for sale securities Wednesday to create $21 billion in cash. Astute market observers realized that selling these safe securities available for sale instead of holding them generated a $1.8 billion loss. So SVB went to the equity market to plug the hole. What's the big deal? The big deal is that SVB needed $21 billion in the first place. 10% of total assets is a lot of cash to have to come up with all at once, and it had the market wondering if the liquidity problems being telegraphed by SVB might be a symptom of a disease it picked up from the broader banking environment. Right before SVB collapsed, its deposits were backed by more reserves than ever before. They also had a total of $32 billion in available secured credit at the Federal Reserve Bank and the Federal Housing Loan Bank of San Francisco, just in case. In order to fight off collapse, it's the demand deposits that SBV needed. If more than $14 billion worth of those $81 billion worth of depositors walked in and started making demands about their money, and those demands weren't met, it could get ugly. And it did. Silicon Valley Bank is an FDIC-insured bank that is supervised and regulated by the Federal Reserve. Banks in that class all do some version of the same thing: take deposits from customers and make loans to other customers at a higher rate of interest than they are paying on those deposits. They had a private banking and wealth management division that catered to the executive leaders of the innovation economy. Despite charging fees for almost everything, the non-interest generating part of their business, everything it does outside of money lending, lost money. Why? Because the bank built relationships with executives in the innovation economy and lent money to them against their stock positions. This bank's core value proposition was that they understood discretion. Let me dive into that. A Form 4 is a 2-page document which covers any buy and sell orders as well as the exercise of company stock options by an executive. Filing a Form 4 can be a real buzzkill. Picture this: a founder has a $1 billion equity position in a stock but wants to buy a submarine. To get that cash, they would have to sell stock, which would mean filing a Form 4, which then some killjoy would probably read, screenshot, and plaster all over Reddit. Or even worse, a blog. People read financial books and it tells them insider selling is bad, which could really hurt the stock price. Silicon Valley Bank could make a loan against that stock position or find some other capital gunslinger who could make such a loan, saving this visionary founder from having to file a Form 4 and get them that cold hard cash so that they can go buy their submarine. Yes, the bank gave these executives the capital they needed to fund their lavish lifestyles, even if the value of their stock went down. Bankers and executives understand each other, and banking is about trust. But here's where the problem lies. 55% of the SVB loan portfolio consisted of loans to venture capital and private equity funds that incubate the technology startups. SVB made direct loans to early-stage aggressive growth startups, but a typical SVB deal involved the bank lending to a VC fund, which then invested in a startup on behalf of its investors. The target companies were about software that makes software, reshuffling the rental market, or something to do with crypto. And in a low-rate environment, capital moved up the risk curve to chase yield. So these high-growth companies were effectively the source of raw materials for money merchants and their lenders. A VC fund could park its investors' capital in a startup seed round, watch it grow its top-line revenue at a loss, sell the seed stock into another VC fund that was late to reply to the subscription email for the Series A round offering, and get a valuation lift that doubled their money. The fund's investors would surely reinvest the proceeds, giving the VC outfit more managed capital and an opportunity to leverage its next moves with a loan from SVB. The problem was that the VC fund's most valuable asset was its investors, and the subscription contracts came with capital calls built into them. The idea was supposed to be that the VC fund could demand additional capital from its investors and liquidate their position in the fund if they couldn't come up with it. Stop me if you've heard this one before. The manager of a venture capital fund walks into a Silicon Valley bank, sits down at the loan desk, and spends 15 minutes or so chatting with the loan officer. The two went to Stanford together, and their wives are in the same yoga class. Eventually, the VC guy asks to borrow $110 million. He wants to make sure that the $300 million of investor capital he has already put down into various companies keep operating. So he is going to invest more money into these investee companies. What have you got for collateral? Asks the loan officer. Well, most of our valuable assets is our investors, who are contractually obligated to reinvest as much money in our fund as they've already invested whenever we tell them. Wow, says the loan officer. They have signed up for that? They sure did. And we'd be happy to pledge those cash calls as collateral for this loan. That sounds like fine security. I can't believe you sold them on that cash call. Nice work. How much did you want to borrow again? 110 million? Yeah, 110. But we might be able to use more, so can we make it 110 million now, but then you have to give us another 290 million whenever we tell you to? Then the loan officer, who knows that all the investee companies are all bullshit, signs the commitment for the loan because he wants to do big deals, wants the service fees, and doesn't want his wife to feel left out at the local yoga class. But the loan officer assumes he's going to be out of the business and filthy stinking rich by the time that this whole tech bubble blows up, so he doesn't really care about the long-term consequences. He just assumes that there's going to be more money coming in as long as he is a loan officer with the bank. So when we break down that loan portfolio, it's easy to understand why the street lacks confidence in Silicon Valley Bank. They relied too much on the tech bubble, and it was bound to burst. The bank lost money outside of money lending, and it relied too heavily on the volatile tech industry. And it's kind of like having a relationship that you know isn't right for you, but you keep going back to it. When I spoke to the great Jim Rogers, he said to me, Steve, bubbles always pop eventually. Both the banking industry and the VC world are all about relationships. There's going to be a lot more contagion to come. For now, we sit back and see if asshats like David Sachs get their way crying for a bailout for depositors. And maybe in this case, he's right. Depositors didn't ask for their bank to lend out their money to wineries. Yes, Silicon Valley lent out 1.6% of their portfolio to high-end wineries. Probably also owned by families of yoga-loving wives and Stanford graduates who benefited from this whole VC ecosystem.
I think your AUM is positively correlated with the bags under your eyes.
If you mean it's getting bigger, you're correct.
I mean,